Have you ever found yourself just staring at a really dense report, maybe corporate financial statement, something like that, and you just feel that immediate wave of like overwhelm? How do you even start to pull out what's important without getting totally lost?
Yeah, it happens all the time.
Well, that's exactly the challenge we're diving into today. Our mission is to show you how to cut through that complexity. We're not just going to read a document. We're actually going to treat it like a live interview, using a bank of, podcast questions to find the good stuff.
Like interviewing the information itself.
Exactly, interviewing the information.
And for this deep dive, our main source is really fascinating. It's a 2005 letter to shareholders from WESCO Financial Corporation. And it was written by the legendary Charles T. Munger.
Ah, okay. Munger himself.
Yes. And alongside that, we'll be using a pretty comprehensive list of interview questions covering all sorts of topics. The goal here is to show how this kind of structured questioning approach can turn dense data into, well, crystal clear understanding for you, our listener, help you spot what really matters.
All right, love that approach. So let's start our interview with WESCO. If we were asking, what inspired your journey or tell us about your background, what does Munger's letter immediately tell us about WESCO?
Well, the letter right away paints a picture of some pretty significant financial performance in 2005. WESCO's consolidated net operating income saw a big jump. Went from about $47.4 million in 2004 up to nearly $78 million in 2005.
Okay, that's a solid increase.
Yeah, it's a leap from $6.66 per share to $10.95. But here's where it gets interesting. Their consolidated net income, notice the difference, was even more dramatic. It skyrocketed to almost $294.6 million.
Wow, that's way higher. $41.37 per share.
Exactly. And that difference between operating and the much bigger net income, that's a key distinction Munger really wants shareholders to grasp. It signals there's more going on than just the day-to-day business.
Got it. So not just operational stuff driving that huge number.
Right. And what's also clear right away is that WESCO isn't just one single business. It's a diversified holding company. It operates through four main subsidiaries. You've got WESCO Financial Insurance, or WESIC, that's reinsurance. Then there's the Kansas Bankers Surety Company, which is actually a WESIFIC subsidiary specializing in insurance for Midwestern banks.
Okay.
Then Court Business Services, they do furniture rental. And finally, Precision Steel Warehouse, Inc., for steel warehousing.
So insurance, banking insurance, furniture, and steel. Pretty diverse mix.
Very diverse. And overall, WESCO's net worth grew too, from $2.12 billion up to $2.23 billion by the end of 2005. Munger also makes a point to clarify that the supplementary earnings breakdown in his letter, it's purely for shareholder utility. It differs a bit from standard audited statements, just to give a clearer picture.
Okay, that context is super helpful. It tells us WESCO is this collection of different businesses. That implies a different risk profile, different management challenges than, a company focused on just one thing. So to really get our heads around these different parts of WESCO, let's apply some of those business and entrepreneurship questions to each segment. Where should we start?
Let's start with WESFIC, the insurance arm. Their reinsurance business is pretty interesting, especially their willingness to insure against what Munger calls super catastrophes.
Super catastrophes, okay.
Yeah.
Big risks.
Big risks. They're also active in aviation risk pools, had about 10% in hull and liability pools for 2004-2005, and they increased their stake in workers' comp pools from 5% in 2005 to 12.5% in 2006. Something else notable, in late 2004, they terminated a multi-year property and casualty contract. That involved a $43.1 million payment.
A payment from them. So they paid to get out of it.
Yes, exactly. It wasn't a loss forced on them. It was a deliberate choice to exit that contract.
Interesting. And how were their results overall?
Munger calls their underwriting results satisfactory and their combined ratios much better than average. Specifically, 75.9% for 2005 and 77.8% for 2004. And that's excluding the effect of that commuted contract.
Okay, for listeners maybe not deep in insurance, why are those ratios significant? What does much better than average actually mean here?
Right, good question. So the combined ratio is really crucial in insurance. It's basically expenses plus losses divided by the premiums they earned. A ratio below 100% means the insurer is making a profit just from its core business of underwriting risk before even considering investment income.
Yeah.
And Wes Effie's ratios in the mid-70s, that's exceptionally low. It signals really remarkable underwriting discipline.
So they're not just writing any business, they're very selective.
Precisely. It shows Munger isn't just chasing growth for growth's sake. He's focused on writing profitable business, even if it means walking away from a big contract like that $43 million one.
That really speaks to that long-term, value-oriented approach, doesn't it? Managing risk carefully.
Absolutely. It's a key insight. Now, next up is the Kansas Bankers Surety Company. WESCO bought them in 1996 for about $80 million, and Munger describes it as a very satisfactory acquisition.
Always good to hear. What's their niche?
Highly specific. They provide things like bank deposit guarantee bonds, directors and officers indemnity, employment practices, liability insurance, and even internet banking catastrophe theft insurance, all for small to medium-sized community banks across about 30 states.
Wow, okay. Very focused.
Very. And they made a significant strategic shift back in 1998. They decided to keep more of the business on their own books, essentially. They now only reinsure about 13% of their premium volume. That's way down from almost half before.
So they're taking on more of the risk themselves.
Yes. Munger notes this makes their income more irregular year to year, but he believes it will have favorable long-term effects. More risk, potentially more reward. Their combined ratios were also very strong. 58.8% for 2005 and 74.9% for 2004.
That strategic pivot, retaining more business. It's really interesting. It makes you think, how important is that kind of innovation or adaptation, even in a seemingly stable niche? They had to adjust to maximize long-term value.
Absolutely. Kansas Bankers clearly shows that kind of adaptability.
Okay, who's next?
Cort. Yep. Cort Business Services Corporation. WESCO bought them in 2000 for $386 million. They're known as the country's leader in rent-to-rent furniture.
Rent-to-rent, okay.
Their revenues in 2005 hit $384 million. Most of that was furniture rental, about $304 million. Then furniture sales at $72 million, and a smaller piece from apartment locator fees. And they saw a big improvement in profit, $20.7 million after tax in 2005, way up from $5 million the year before.
That sounds like a good turnaround.
It was. However, Munger's letter is incredibly candid here. He basically says they were poor predictors of near-term industry-wide prospects when they bought Cort back in 2000.
Really? He admits that?
Oh, yeah. He specifically mentions the big impacts from the dot-com bubble bursting, then 9/11, and just a general slowdown in new businesses being formed.
Wow. So they bought it, and then bam, a bunch of headwinds hit the industry.
Exactly. It highlights the kind of unexpected challenges that can pop up after a major acquisition. You can't predict everything. Cort also had to make changes. They had this venture called Relocation Central, started in 2001. By 2004, they reorganized it to be much more internet-focused, a clear pivot, adapting the model.
Adapting to survive, sounds like.
Pretty much. The letter also gets into the accounting side, specifically goodwill. About 60% of Cort's purchase price was goodwill.
Right. That's the amount paid over the value of the actual tangible assets.
Correct. Often reflects things like brand reputation, customer lists, that kind of intangible value. Munger mentions a 2002 accounting rule change by FASB, that's the Financial Accounting Standards Board. The rule changed how goodwill was treated. Instead of automatically reducing it each year, called amortization, companies now had to assess it annually for impairment, meaning they only write it down if its value has genuinely decreased.
And Munger preferred the new rule.
Yes, he states it more closely reflects microeconomic reality. He felt it was a more accurate picture of the business's real economic state. Oh, and he gives a shout out to Paul Arnold, Cort's CEO, calls him a star executive.
Okay, so there's a lot baked into the Cort story. The initial mistiming, the external shocks, the operational pivot, the accounting nuances. When you put it all together, what's the key takeaway here about how businesses navigate downturns, especially after a big buy?
Well, if we connect this to the bigger picture, I think the Cort experience really hammers home the importance of resilience, adaptability, and crucially, having sound financial accounting and really strong management in place when you make these big acquisitions, especially when unexpected economic storms hit.
Yeah, it's not just about buying right, but managing right afterwards.
Exactly. It's the ongoing strategy, the leadership, that willingness to adapt.
Okay, who's left? Precision Steel.
Precision Steel Warehouse, Inc. Their after-tax profits were smaller, $1.2 million in 2005, $1.1 million in 2004. But Munger points out these numbers were affected by a couple of things: LIFO inventory adjustments and some environmental cleanup costs.
LIFO. Last in, first out. Can you remind us how that affects profits, especially with something like steel where prices can fluctuate?
Sure. So LIFO assumes the last inventory you bought, which is usually the most expensive in times of rising prices, is the first one you sell. This means your cost of goods sold looks higher, which in turn makes your reported profits look lower on paper.
Got it. So the actual underlying profitability might be a bit different than that headline number suggests.
Potentially, yeah. It's a conservative accounting method in inflationary periods. Munger also notes their business is very subject to economic cycles, and they face intense competition, particularly from outside the U.S.
Makes sense for steel.
Definitely. He describes early 2004 as almost chaotic due to a raw material shortage. Prices spiked. Precision Steel managed to pass those higher costs on to customers, though. Revenues jumped 31.2% in 2004, even though the actual volume, pounds sold, was only up 14.5%.
So price increases drove most of that revenue growth.
Yes. But 2005 was different. Still tight supply, but competition ramped up and demand softened a bit. So pounds sold actually fell 8.6%. Revenues were still up slightly, 1.4%, but only because of those higher selling prices carrying over.
So a tougher environment in 2005.
Yeah, and Munger expresses some caution here. He suggests these recent favorable results may have been anomalous and temporary. He says the whole industry is in a state of flux, and he points out that their revenues from 2001 to 2003 were significantly lower than back in 1998-2000.
So acknowledging the cyclical nature and the current uncertainty.
Exactly. But he gives clear praise to Terry Piper, their president and CEO, saying he did an outstanding job navigating these tough years.
You know, it makes me think, what's a common misconception people might have about an industry like steel? Maybe it's just a stable foundational thing. But Munger's letter really shows it's subject to huge volatility, global pressures, raw material chaos, and it's anything but static.
That's a great point. It's foundational, yes, but definitely not always stable.
Okay, so we've looked pretty closely at the operational side of WESCO's different businesses, but Munger's letter, as you said, goes beyond that. It gives us some really fascinating insights into their broader investment and financial strategies. Let's shift gears and apply some investing questions.
Right. And one big item jumps out immediately in the 2005 financials. WESCO reported this massive $216.6 million after-tax investment gain.
Whoa, compared to zero the year before.
Compared to zero in 2004. But here's the kicker, the crucial detail that really shows Munger's transparency. Only $500,000, $2.5 million of that huge gain came from actually selling investments.
Okay, so where did the other, $216 million come from?
It resulted from a tax-free exchange of Gillette Company shares they held for Procter & Gamble Company shares during the merger of those two companies.
Ah, the P&G Gillette deal, I remember that.
Exactly. Now, accounting rules, specifically GAAP, generally accepted accounting principles, required them to record the fair market value of the new P&G shares as a new cost basis. And doing that created this huge paper gain on the financial statements.
But they didn't actually sell the shares and get cash.
No cash was received. And Munger explicitly states it had no economic effect on WESCO. He actually advises shareholders, quote, ignore it when you are evaluating WESCO's 2005 earnings.
That is fascinating. He's basically telling people, hey, there's this huge number on our income statement. Pay no attention to it.
How does this specific example maybe illuminate some common mistakes beginner investors make, especially when they're just looking at the headline numbers in a report? Oh, it's a perfect illustration. It's a masterclass, really. It teaches you that just because a huge gain is reported on paper doesn't mean cash came in the door. It doesn't necessarily reflect a brilliant investment decision made that year.
Right. It was a consequence of a merger in accounting rules.
Exactly. Munger is forcing you to look beyond the accounting entry to the underlying economic reality. Did the company's actual wealth or cash position change? In this case, no.
That's a really crucial distinction. Don't confuse accounting with cash flow or real economic change.
Couldn't have said it better. Another interesting financial nugget Munger points out is what he calls an interest-free loan from the government.
An interest-free loan, how does that work?
He's referring to WESCO's deferred income taxes. These are taxes that are owed based on accounting profits but haven't actually been paid yet, usually because of differences between tax rules and accounting rules. At the end of 2005, this amounted to about $36 per WESCO share.
So that's like they get to hold on to that cash and use it for a while before paying the tax man.
Essentially, yes. But Munger quickly adds a caveat. He emphasizes this is no perpetual advantage because that loan might have to be repaid, when securities are eventually sold and the taxes become due. So its present value today is actually much lower than the face value.
Okay, so it's a benefit, but not as big a benefit as it might look at first glance, and it's not permanent.
Right. It's a nuanced point.
And if we connect that back, it really underscores how vital financial literacy is, doesn't it? To grasp these subtleties on a balance sheet. It's not just about the big numbers.
Absolutely. You need to understand the why behind the numbers. And speaking of candor, Munger offers this incredibly direct comparison between WESCO and its parent company, Berkshire Hathaway.
Oh, this should be good. What does he say?
He states, point blank, that WESCO's business quality and human quality are, quote, not nearly as good as Berkshire Hathaway.
Wow. He actually said that in his shareholder letter.
Yep. He goes on, WESCO is not an equally good but smaller version of Berkshire Hathaway. And he says, each dollar of book value at WESCO continues plainly to provide much less intrinsic value than a similar dollar of book value at Berkshire Hathaway.
Ouch. That's brutally honest.
It is. He even notes that this disparity in intrinsic value continued to widen in favor of Berkshire Hathaway during that period. And importantly, he explicitly tells shareholders not to use his letter to appraise relative attractiveness for investment of WESCO versus Berkshire Hathaway stock at present stock market quotations.
That is just incredibly rare. That level of direct, potentially negative comparison from a top executive about his own company versus its parent. It really makes you think, doesn't it? About maybe that question, what advice would you give your younger self? Perhaps it's always look past the surface. Look beyond just the name or the association and really dig into the intrinsic value and actual quality of the business you're looking at, not just how the market perceives it.
That's a fantastic takeaway. It's a powerful lesson in valuing substance over perception. And then finally, looking towards the future in the letter, Munger discusses WESCO's outlook. They were holding a lot of cash, over $1 billion in cash equivalents and fixed maturity investments since early 2003.
$1 billion, that's a nice cushion.
It is, but for a value investor like Munger, it's also a bit of a problem if you can't find good places to invest it. He expresses concerns, saying, unless those funds can be attractively reinvested, future returns on shareholders' equity will probably be less than those of the past.
Right. Sitting on too much cash drags down your overall return on equity if you can't deploy it effectively.
Exactly. It signals that maybe attractive, undervalued investment opportunities were becoming harder to find at that time. Despite this cautious outlook on reinvestment, the board did nudge up the regular dividend slightly, from 35.5 cents to 36.5 cents per share.
It raises an interesting question for any company in that position, right?
Yeah.
What motivates you to keep pushing? To find new growth avenues when maybe the obvious opportunities are drying up or investments look expensive?
It's a fundamental challenge for long-term capital allocation.
So beyond those main business segments in the big financial picture, Munger also includes some, what he calls tag ends in the letter. Little extra bits.
Yeah, his term tag ends, it's like he's giving a peek into some of their other, maybe smaller activities.
What sort of things?
Well, there's a small real estate subsidiary, MS Property Company. It holds some appreciated assets, including WESCO's own 9-story commercial office building in Pasadena, California. Most of it is actually leased out to others, like Citibank.
Okay, so managing their own property.
And more than that, they were actively getting into real estate development. The letter mentions they were constructing a multi-story luxury condominium building right next to their headquarters.
Luxury condos, really?
Yep. And planning another one in the next block over.
Huh. That's unexpected for a company focused on insurance and steel and furniture rental.
It is a bit surprising. He also briefly mentions other operating earnings. These jump from $0.4 million in 2004 to $5.2 million in 2005. And that came mostly from rents, presumably from the office building, and investment income held outside the main insurance subsidiaries.
So if we were like playing that interview game and asked WESCO, for a fun fact most people don't know, it seems like the answer might be, we're not just a financial holding company, we're also becoming a luxury condo developer.
Yeah, probably. It's not just a random detail, though. I think it highlights WESCO's, or really Munger's, opportunistic approach. They had capital, they saw an opportunity, maybe in their own backyard with that Pasadena real estate, and they went for it, even though it was outside their main lines of business.
Right. Managing diverse assets and deploying capital where they see value. You know, the whole deep dive using the letter and these questions, it really drives home that core lesson, doesn't it? How applying this structured, inquisitive approach, asking probing questions, can light up even complex financial documents. It reveals so much more than just passively reading.
Yeah, it's about being an active interrogator of the information, not just a recipient.
Exactly.
And understanding these reports, it's not just about crunching the numbers. It's about uncovering the stories behind the numbers, the strategic choices, the challenges faced, the unique viewpoints of the people involved, like getting these incredibly candid insights directly from Charlie Munger.
You learn not just what happened, but why it mattered and what the bigger implications might be.
Couldn't agree more.
So here's a final thought for you, our listener. The next time you encounter a dense report or maybe a complex news story or really any chunk of information, try thinking about which interview questions you'd ask that material itself. What hidden stories or essential lessons or maybe underlying philosophies might you uncover about the journey, the challenges, the unstated goals? The answers might just surprise you.